Welcome to the channel. In today's video, we are talking about one of the most important skills for every entrepreneur, small business owner, and company manager: budgeting. If you want your business to survive, grow, and remain profitable, you must learn how to control your money before your money controls you. Budgeting is not only for big corporations. It is also for a small shop, a startup founder, an online seller, a service provider, and any entrepreneur who wants to build a stable future. In this video, I will explain budgeting in a simple and practical way so that you can apply it in your own business immediately. Stay with me until the end, because I will also share common budgeting mistakes and the easiest way to create a smart business budget. Let us begin with a simple definition. A budget is a financial plan that shows how much money your business expects to earn and how much it plans to spend over a specific period. That period can be weekly, monthly, quarterly, or yearly. A budget helps you decide where your money should go. It also helps you avoid waste, reduce financial stress, and prepare for the future. Without a budget, many businesses operate blindly. They sell products, receive money, and spend it quickly without knowing whether they are making progress or losing control. When that happens, even a business with good sales can still fail. That is why budgeting is not optional. It is a leadership tool, a survival tool, and a growth tool. For a small business, budgeting creates discipline. Imagine you run a retail shop, a mini market, a restaurant, or a clothing store. Every day, money comes in and money goes out. You pay rent, restock goods, buy electricity, support staff, and cover transport costs. If you do not track these numbers carefully, you may think the business is doing well simply because cash is moving. But movement is not the same as profit. Budgeting shows the truth. It helps you measure the cost of inventory, the expenses of daily operations, and the actual amount left after all payments are made. A good budget gives you control and helps you make decisions with confidence instead of guessing. For companies, budgeting supports planning and accountability. A company usually has different departments, different responsibilities, and larger financial commitments. Marketing needs funds, operations need funds, salaries must be paid, and growth projects require investment. A company budget makes it easier to allocate resources properly and evaluate performance over time. Managers can compare what was planned against what was actually spent. This makes it easier to see which department is overspending, which investments are producing results, and where adjustments are needed. In other words, budgeting helps a company stay organized, transparent, and focused on long-term goals. For startup entrepreneurs, budgeting is even more critical because startups usually operate with limited money and high uncertainty. A startup may have a brilliant idea, but without financial discipline, it can run out of cash before reaching success. This is why founders must understand concepts like burn rate, runway, and cost priorities. Burn rate is how quickly the business is spending money. Runway is how long the business can survive before money runs out. If a startup does not budget well, it may spend too much on branding, office setup, or unnecessary tools while ignoring the core product, customer growth, or essential operations. Smart budgeting helps startups stay lean and invest in what truly matters. Now let us talk about the main parts of a business budget. The first part is income. This includes all the money the business expects to receive from sales, services, subscriptions, or other business activities. The second part is fixed costs. These are expenses that usually stay the same, such as rent, salaries, insurance, software subscriptions, or loan payments. The third part is variable costs. These expenses change based on activity, such as inventory purchases, packaging, fuel, shipping, commissions, and utility costs. The fourth part is savings and emergency reserves. Every business should set aside some money for unexpected situations, because emergencies are not a matter of if, but when. The fifth part is growth investment, which includes money for expansion, marketing, equipment, staff training, and innovation. One practical budgeting method is to separate your spending into categories. For example, you can assign a percentage of revenue to stock or production, another percentage to operations, another to marketing, another to savings, and another to owner pay or reinvestment. The exact percentages may change from one business to another, but the principle is simple. Every dollar, shilling, or franc should have a purpose before it is spent. This prevents emotional spending and random financial decisions. It also helps you identify which category is consuming too much money. When you categorize expenses properly, it becomes much easier to optimize the business and increase efficiency. Let us now discuss how to create a simple budget. Step 1 is to estimate your expected income for the month. Be realistic, not overconfident. Step 2 is to list all fixed expenses. Step 3 is to estimate variable expenses based on previous records or reasonable projections. Step 4 is to assign money for emergencies and savings. Step 5 is to compare total expenses against expected income. If expenses are higher than income, you must reduce costs, increase prices carefully, improve sales, or delay non-essential spending. Step 6 is to review the budget every week or every month. A budget is not something you create once and forget. It must be reviewed, corrected, and improved continuously. A common budgeting mistake is mixing personal money with business money. Many entrepreneurs do this, especially in the early stages. They use business cash for home expenses, social spending, or personal emergencies. Then later they cannot understand why the business is short of money. This creates confusion and weakens the financial health of the business. Another mistake is failing to record small expenses. Sometimes it is the small daily costs that slowly damage profitability. Transport, snacks for staff, extra printing, phone credit, and unplanned purchases may seem small, but over time they add up. Budgeting works best when you record everything honestly and consistently. Another major mistake is budgeting without data. If you do not know your past sales, average costs, or seasonal patterns, your budget will be weak. Good budgeting depends on records. You do not need complicated software to start. A notebook, spreadsheet, or simple accounting tool can help you track daily sales and expenses. What matters most is consistency. Data allows you to forecast better, prepare for slow months, and make informed decisions. For example, if you know certain months bring lower customer traffic, you can reduce unnecessary spending in advance. If you know a product line produces better margins, you can focus more resources there. Budgeting also improves confidence when speaking to lenders, investors, and partners. When you can clearly explain your expected revenue, your cost structure, and your financial priorities, people trust your business more. A budget shows seriousness. It demonstrates that you are not operating randomly. It shows that you understand risk, planning, and growth. This is especially important for startups seeking support because investors want to see that money will be used wisely. Even for a small business applying for a loan, a realistic budget can strengthen your case and improve your credibility. If you want your budget to be effective, involve the right mindset. Budgeting is not about fear. It is about direction. It is not about restricting every idea. It is about making sure your ideas are financially sustainable. When you follow a budget, you become more intentional. You spend on what builds value and avoid what creates unnecessary pressure. This mindset helps businesses become stable and resilient. During hard times, a disciplined budget can protect the business. During good times, a disciplined budget can help the business grow faster and smarter. Here is a simple example. Suppose your business expects to make $1,000 this month. You might allocate $400 to stock or service delivery, $200 to rent and operations, $100 to marketing, $100 to salaries or support, $100 to emergency savings, and $100 to business growth. This is only an example, but it shows the principle clearly. The goal is not perfection on day one. The goal is control, awareness, and improvement. Once you build the habit of budgeting, your decisions become stronger and your business becomes more stable. Let me give you practical advice for starting today. First, write down every source of income. Second, list every expense. Third, separate needs from wants. Fourth, plan for emergencies. Fifth, review your budget regularly. Sixth, use your budget to guide purchasing decisions, hiring decisions, and expansion decisions. And finally, never assume sales alone means success. Profit, cash flow, and discipline matter more. A business can be busy and still be financially weak. Budgeting protects you from that danger and helps you build a business that lasts. To conclude, budgeting is one of the strongest foundations for success in a small business, a company, or a startup. It helps you control expenses, plan growth, prepare for challenges, and make smarter decisions. If you are serious about business, take budgeting seriously. Start simple, stay consistent, and improve over time. Thank you for watching. If this video helped you, remember to subscribe, turn on the notification bell, and share this video with other entrepreneurs who want to grow wisely. Keep learning, keep building, and keep leading your business with confidence. Before we end, let us make this even more practical with a simple monthly budgeting routine that any entrepreneur can follow. At the beginning of each month, start by reviewing your sales from the previous month. Look at which products or services generated the most money and identify the areas where expenses were too high. Then set a realistic income target for the new month. After that, list your non-negotiable costs first. These are the costs you must pay to keep the business running, such as rent, staff wages, loan payments, internet, transport, and stock replenishment. Once those essentials are clear, decide how much money you can safely allocate to growth. This may include promotion, better tools, small upgrades, or customer service improvements. By following this routine every month, you give your business a clear financial structure and avoid operating in confusion. It is also important to understand the difference between profit and cash flow. Profit is what remains after your business income is higher than your total expenses on paper. Cash flow is the actual movement of money in and out of the business at a given time. A business can appear profitable and still struggle because cash is not available when bills are due. That is why smart entrepreneurs do not only ask, "Am I making profit?" They also ask, "Do I have enough cash at the right time to pay for what the business needs?" Good budgeting helps protect both profit and cash flow. It allows you to prepare for supplier payments, salary dates, tax obligations, inventory needs, and seasonal slowdowns without panic. For startup founders, one of the smartest budgeting habits is prioritization. In the early stage, not every attractive idea deserves immediate spending. You may want a better office, expensive branding, more software tools, or a larger team, but the real question is whether those costs directly support the product, the customer, or the revenue. A disciplined founder learns to separate urgent needs from attractive distractions. That kind of discipline extends the runway and gives the business more time to learn, improve, and grow. In many cases, startups do not fail because the idea is bad. They fail because spending is faster than progress. A budget acts like a compass. It keeps the founder focused on the few things that matter most. You should also schedule a regular budget review meeting, even if you are the only person in the business. Sit down once a week or once a month and ask a few simple questions. What did I plan to spend? What did I actually spend? What created value? What was unnecessary? What should change next? These questions help you move from reacting to leading. Over time, your budget becomes more accurate, your decisions become more strategic, and your business becomes more resilient. Remember, a budget is not meant to make you feel limited. It is meant to help you use your resources wisely so that your business can stay strong, serve customers well, and build long-term success. If you apply these ideas consistently, your business will gain more stability, more clarity, and more confidence. Whether you run a small shop, manage a growing company, or build a startup from scratch, budgeting gives you a stronger foundation. Keep your records clean, review your numbers regularly, protect your cash flow, and make every important expense intentional. That is how smart entrepreneurs grow sustainable businesses. One final reminder for every entrepreneur watching this video: budgeting is a habit, not a one-time event. The more regularly you review your numbers, the more clearly you will see opportunities, risks, and areas that need improvement. Do not wait for a financial crisis before taking control of your money. Start now, even with a simple notebook or spreadsheet, and build the discipline step by step. Strong businesses are not built only by hard work. They are built by wise decisions, clear priorities, and responsible money management. Keep learning, stay focused, and let your budget become a tool that supports your vision, your growth, and your long-term business success.